Beijing just dropped a financial bombshell while the world was asleep, a maneuver so audacious, so meticulously timed, that it could rewrite global markets before most investors even realize what hit them. $80 silver is quietly loading into the system while the CME's $25,000 margin infrastructure strains under pressures it was never designed to withstand. Ordinary citizens, retirees, and savers are unaware they are standing on the edge of a financial cliff, their life savings dangling precariously above invisible trapdoors. And yet, for those who grasp the hidden mechanisms of government strategy, there is a fleeting opportunity, one that could redefine wealth in ways most could never imagine. This isn't speculation. It's a carefully orchestrated high-stakes maneuver, and the consequences are immediate, tangible, and potentially catastrophic for anyone unprepared. Imagine the global financial system as a sprawling game of musical chairs, where each chair represents stability, liquidity, or solvency. Over decades, central banks, governments, and shadow financial networks have been quietly removing chairs, relocating them, or camouflaging them behind layers of policy and regulation. Every new dollar of national debt issued, every bond rolled over, and every derivative created is another chair silently taken away. Now, Beijing has shifted one of the heaviest chairs, the silver market, leaving countless portfolios, pensions, and savings accounts teetering on the edge. The market's foundations, once thought solid, are being challenged not by rumors or sentiment, but by precise mathematical and systemic maneuvers designed to exploit hidden vulnerabilities. Silver has always been more than a mere commodity. It is a barometer of real value. From the bimetallic standards of the 19th century to the post-1971 fiat currency era, governments have manipulated its price to anchor currencies, control markets, or quietly enrich insiders. Beijing's current recalibration of silver mirrors the Kennedy-era silver reserve movements, but it is magnified by modern global leverage, high-frequency trading, and interconnected digital markets. By quietly restricting supply while increasing demand, the government is engineering a scarcity that could ripple across every exchange and portfolio worldwide. To the casual observer, it may seem like a market spike, but behind the scenes, this is a masterclass in financial strategy designed to recalibrate value on a global scale. The mechanics of this maneuver are deceptively simple, yet devastating in impact. Futures contracts, particularly on the CME, are margin-based. Traders only post a fraction of the contract's value to participate. For example, a $25,000 margin might control a contract representing 1,000 ounces of silver at $25 per ounce. When silver spikes to $80 per ounce, that same position balloons to $80,000. Traders unprepared for this explosive growth face immediate liquidation, a domino effect that cascades through connected markets. Picture walking across a frozen lake with cracks invisible beneath the surface. Each step seems safe until suddenly the ice gives way, and you are plunged into freezing waters with no warning. This is the reality of margin-based markets during an engineered commodity surge.
But silver is only part of the equation. Hidden within the frameworks of crypto and digital currencies, governments and central banks are quietly constructing digital reserves tied to real-world assets. These frameworks allow a nation to move value between fiat currencies, commodities, and blockchain-based holdings without public scrutiny. To the average investor, cryptocurrencies may seem like speculative tools or stores of value, but in reality, they are becoming instruments in a larger orchestrated revaluation strategy. Each digital coin, tokenized asset, or stablecoin backed by precious metals is a node in a complex, interlinked system designed to redistribute wealth systematically. Ordinary savers, unaware of these invisible levers, are exposed to hidden risks that can be triggered by nothing more than a single government directive or market shift. The speed of these changes is what makes them particularly dangerous. National debt grows at a relentless pace, compounding like a snowball rolling down an increasingly steep mountain. Each year, trillions of new obligations enter the system, stretching liquidity, increasing leverage, and narrowing margins of safety. Governments have tools, such as executive orders, subtle regulatory changes, or adjustments to asset valuations, which can suddenly shift the landscape in ways ordinary citizens cannot anticipate. Retirees and savers, particularly those relying on fixed income or dollar-denominated assets, face constricting windows of opportunity. The difference between acting today and waiting even a month could mean tens of thousands of dollars in lost purchasing power, or conversely, life-changing gains for those who understand the mechanisms at play.
Consider a vivid metaphor. The global financial system is a symphony orchestra, where every instrument represents a segment of the economy: banks, bonds, commodities, digital currencies, and derivatives. Normally, the music flows in a harmonious rhythm. Now, Beijing hits a single powerful note: silver's recalibration, the The music fragments into chaotic dissonance, futures contracts shudder like overstrained strings, margin calls boom like rolling timpani, and digital assets quake in response. For those unprepared, the experience is deafening, disorienting, and financially devastating. The orchestral metaphor isn't poetic license. It is a literal depiction of how interconnected markets can implode when one strategically manipulated asset shifts dramatically. Historical parallels amplify the sense of urgency. Recall the 1971 Nixon shock when the U.S. unilaterally ended the gold standard. Markets staggered, currencies reeled, and ordinary citizens woke to diminished purchasing power overnight. Today's silver maneuver is smaller in scope but exponentially more interconnected. Digital trading, high-speed algorithms, and global liquidity flows magnify the impact. While historical shocks were localized to currency systems, this modern movement reverberates through commodities, derivatives, digital currencies, and global trade, creating a synchronized crisis potential unseen in prior decades. Now, let's break down the numbers for clarity. A single CME silver contract controlled by a $25,000 margin represents roughly 1,000 ounces of silver at $25 per ounce, a total notional exposure of $25,000. When silver rises to $80 per ounce, that exposure jumps to $80,000. Margin calls are triggered automatically. Positions are liquidated in a cascading effect, which drives further volatility. Multiply this by hundreds of thousands of contracts, interlinked via clearinghouses and derivative positions, and the system teeters on a knife's edge. The mathematics are clear. This is not a speculative warning. It is an imminent, calculable threat to unhedged positions. The consequences for ordinary citizens are profound. Dollar-denominated savings, 401ks, pensions, and fixed income investments are vulnerable to silent devaluation. Even digital asset holders are exposed if their holdings are leveraged, under-collateralized, or tied to fiat-based systems. The analogy is simple. Imagine standing on a trapdoor that only insiders can see. Every dollar held in conventional or digital forms is above that trapdoor, its value subject to sudden, invisible recalibration. Financial survival now depends on awareness, strategic positioning, and rapid response. The urgency cannot be overstated. Opportunities for protection or profit are fleeting. Those who understand commodity revaluations, digital reserve frameworks, and global leverage mechanics can act decisively, hedging strategies, diversifying into physical precious metals, or selectively positioning within crypto frameworks are potential safeguards. Delaying action risks, waking to a world where wealth has silently evaporated, markets are chaotic, and financial security is redefined overnight. Timing is not just critical, it is existential. Beijing's silver recalibration is more than a market anomaly. It is a deliberate, strategic move within a hidden global financial framework. It exploits margin vulnerabilities, manipulates supply and demand, and triggers interlinked shocks across commodities, digital currencies, and fiat systems. Ordinary investors remain oblivious, unaware that trillions of dollars are being silently rerouted, leveraged, or revalued behind layers of policy, algorithmic trading, and global coordination. This is not theory, it is happening now.
Visualize the entire system as a network of invisible trapdoors. Each market, each asset class, each digital ledger represents a node. Governments, central banks, and strategic investors can open or close these trapdoors at will, redistributing value without public knowledge. Ordinary citizens standing on these nodes may be caught unprepared, their savings exposed to sudden shifts that seem inexplicable to the untrained eye. The risk is universal, immediate, and mathematically verifiable. Historical precedent, mathematical logic, and current events converge to paint a stark picture. Global financial stability is precarious. Margins fail, commodity prices surge, digital frameworks conceal leverage, and ordinary savers are caught in a tightening noose. Those who act swiftly and strategically may protect wealth or even capitalize on the upheaval, while those who hesitate risk irrevocable losses.
This is the urgent warning. $80 silver is not merely a headline, it is a signal, a trigger, a harbinger of cascading shifts in value, policy, and strategy. The CME's $25,000 margin system is under unprecedented stress. Digital assets are interlinked with opaque leverage, and global supply chains and trade networks are silently adjusting to these moves. Ordinary citizens, retirees, and investors must pay attention or face irreversible consequences. The time to act is now. Understand the mechanics of silver futures, recognize the hidden digital frameworks, monitor global policy shifts, and position strategically. Wealth, security, and purchasing power are no longer guaranteed by fiat promises or conventional market assumptions. The clock is ticking, and the trapdoors are closing silently, invisibly, relentlessly. Beijing's Bombshell is a masterclass in financial engineering, a calculated orchestration of scarcity, leverage, and global coordination. This is not news to insiders. It is a blueprint for strategic revaluation executed while the world sleeps. The opportunity to protect assets, hedge exposure, and strategically leverage positions is fleeting. Those who fail to understand will awaken to a reality where value has been silently siphoned, margins collapse, and markets convulse. Act now, because while governments and markets play their intricate games of musical chairs and trapdoors, your financial survival depends on seeing the game before it's too late. $80 silver is only the beginning. What follows could redefine wealth on a global scale, and only those prepared will endure.